Hi everyone, hope you're all doing well. Today I'm going to do the new stock that I've started buying on the UK markets. I started buying this stock around about 2 weeks ago, and this is another turnaround play. So a stock that has crashed massively. Few bad news stories out there, that's been pushing it down. But under those bad news stories, I feel like the stock has probably got a little bit too low now, and I'm willing to buy up this stock and think that in the next kind of couple of years, it will turn around, the financials will go up, and this stock will do quite well. So I hope you enjoyed the video. Let's get started. So it was around 8 months ago the last time I bought a turnaround play on the UK market, which was this one here, which was Watches of Switzerland Group. Now, as you guys know, I did buy that stock and I have now sold that stock for a 60% return. Watches of Switzerland was one of those turnaround plays where I looked at the stock and I thought, you know what? There's not many businesses out there that are able to sell Rolexes. Rolex is a kind of luxury company here that I think will still do very well for many years. It's gone way too low over a little bit of fear over profit warnings and the environment that we're in. I'm going to buy that, and it'll go higher as Rolex sales start creeping back up again. It happened a lot faster than what I thought it would, but we did make a good money on that. We sold that one out now for 60% return. And this one kind of came towards me on the Patreon. So on the Patreon and the Discord, we do a stock request where people on the Discord get to vote, or members of the Discord get to vote for me to take a look at a stock, which I think do a little bit more detail on, where potentially I could buy the stock, and it came through there. And when the stock came through, I didn't really consider it, and then when I started having a bit more of a look at it, I went, actually, this is actually pretty interesting. So if you do want access to that, links in the description, £5 a month if you do want to join the private Discord. As well as that, if you do want to start investing, join Trading 212 with the link in the description. You can get a free fractional share worth up to £100. A lot of you guys have been doing that at the moment. So the industry as a whole that this one is in, if you look at CVS Group, if you look at Pets at Home Group, this industry has suffered massively. The kind of pet space. If you look at CVS Group, they kind of had that boom during 2021. If you look at Pets at Home, same again. They had that kind of boom during 2021. And what happened is we had the lockdown situation. But then during 2020, 2021, everybody was locked at home and everyone got a little bit lonely or had a lot of free more time, and they kind of thought, you know what? I'm going to go get a pet. And what we saw in 2021 was a boom in the amount of households that kind of owned pets. There was a massive spike in the pet ownership. So obviously, as you go buy, let's say a puppy, the first thing is obviously you have to have maybe the chips put in, you have to go for the vaccinations, and as well as sales being very good, we had also the medical bills being very good for a lot of these companies. So that had a big boom during 2021, and you can see that in the CVS Group's share price and the Pets at Home share price. Now, the difference between Pets at Home is they're kind of a bit of a retailer of selling pets, pet food, toys, bedding, but they also have the kind of vet space. CVS Group is basically a lot more revenue on the veterinary service. Now, at the moment, my big worry with someone like a Pets at Home is that because it's a retail company and they have a lot of minimum wage workers, and also the NI issues in the UK at the moment from the current government means they're going to have a lot of headache next year as they have to deal with the rise in the minimum wage and also have to deal with the rise in the NI. CVS Group is more of a veterinary service, so a lot of their workers are not on minimum wage. It is a higher paid job, so they won't be as affected as, say, someone like a Pets at Home, for example. And because of that, they're able to also probably pass some of the costs on to the consumer a little bit better. So CVS did come a little bit more interesting to me than Pets at Home because of that reason. And in fact, if you do look at Pets at Home recent update, they actually said that their strongest part of their business has actually been the vets part of the business. So once again, kind of pointing to this, in my opinion, that CVS was one or probably the better interesting play here, but there's other reasons as well. So CVS is the one that I've been buying as a turnaround play, and really since 2021 the stock has fallen down massively, down 62%. But you could also see here as a sector, Pets at Home as well is down 54% during this time frame. Now, I've got to say with Pets at Home you are getting a nice dividend yield with this one compared to CVS, but I think CVS will give you the better share price return. Now, like I said, two of them both come off really tough comps from 2021, the boom that's happened here. But what we have is the CMA. So the CMA has launched a full market investigation into UK veterinary services. Now, they are looking to see if they are overcharging for some of their vet services, which potentially they are doing. I think potentially they can't go too heavy onto them though, because when you do look at them, they are companies that are not making crazy amounts of profit. I think if you look at the companies themselves, the profit margins at the moment is like 4%. So you can't say, oh yeah, they're ripping off the customers, when if they're only making 4%, it's not like they're making crazy money. So there's a lot of fear at the moment that potentially there's a few changes on what CVS Group and what Pets at Home have to do with their veterinary services going forward. But I don't think they can be too harsh, because it's not like they're making mega money on them. And I think a lot of that is kind of being priced into the share prices of these companies at the moment. The other thing as well is that we saw the big boom in the pets and the boom of them being bought in lockdown. They had the first vaccinations, the chips and all that. But some of these pets now are getting 4 or 5 years old. And as we know, when these pets get a little bit older, their medical bills start, they go a little bit quiet around the kind of 2, 3, 4 years. As they get a little bit older, 5, 6, 7, 8, obviously a few more medical issues start happening as they get older. Certain teeth maybe start pulling out. So a lot of these pets, the big booming pet bills, the booming pets are going to, in my opinion, lead to a bit of a boom in the vets bills in the next coming 3 or 4 years. And starting from now is where we're going to certainly see a lot more of it ramping up. Now CVS as well, one of the reasons why they did have this big dip at the moment is they did also have a cyber attack as well this year. They've had a bit of a tough time at the moment, and I think that this has all now pushed the share price into the point of view where it's had so much negative news where actually it's pushed it into probably way too low, where I think actually, I might go buy some shares from CVS Group. Now, the recent results weren't actually too bad. The sector as a whole is actually a sector that's going to grow pretty decent in the next few years. As you can see here, the expected CAGR of 6.9% from this service here. But when we look at the company, the 5-year plan is they're expecting organic revenue growth of 5 to 8%. So that's pretty decent growth, as you can see here. Margin expansion as well, adjusted EBITDA margins from 19 to 23%, and also some other points here that I won't go through here. Now, they're also currently a UK business. One of the big growth drivers for this is potentially the expansion into Australia. Now, the big thing with CVS Group compared to something like Pets at Home, obviously you go down the high street and you see Pets at Home, you recognise the brand. Where CVS Group, you're probably not knowing that one as well, even though it's a pretty decent sized company. The reason why is a lot of them kind of run under these like individual brands, so they look like kind of a separate kind of private veterinary service. Really, they're actually owned by CVS Group, and they have started launching to Australia as an expansion out of the UK. So this is going to be probably one of the big growth drivers, hopefully. You can see here they've actually been acquiring a lot of sites in Australia at the moment. Now, it's worth pointing out that they did, obviously they're quite a strong UK company. They did actually try and expand into Ireland and also Holland. That did fail for them, and they actually did sell off them practices, and that has had an impact on the bottom line at the moment as they sell them off. But they never were able to make profit in these areas, so they did sell them off for not really any. Well, in fact, they sold it off for €2. So it's worth pointing out that this potentially could be a growth driver for them, but actually previously they didn't actually get that much good success out of them. So just kind of bear that in mind. But when you do look at the potential expansion for Australia, as you see here, the current market size potential is currently 5.3 billion at the moment. So a big market to potentially go for here. Now, like I said, I actually don't think the recent financials were actually that bad. If you look here, the like-for-like growth was still 2.9%. Adjusted for the cybersecurity, 4.1%, which is obviously pretty good. A little bit of a decline in the adjusted EBITDA margin, and we said before, they're actually hoping to get that up to a 23% adjusted EBITDA margin. Slight drop in the free cash flow, and you look at the EPS, slight drop in the EPS as you see here. And the dividend did go up slightly, but you can have a little bit of a breakdown here on where that kind of went to. So they talk about some of the inflationary costs, cyber costs here. The adjusted EPS was impacted by corporation tax, an increase in depreciation from increased capital investments in recent years, and increased finance expenses as well. And there's quite a few like one-time charges in there. Now, as you see, there is the revenue share. 86% does come from the vet services, as you can see here, and with the vet services as well growing 10%, and the growth has been pretty good for this business overall. If we look at Stockopedia, by the way, a lot of you have been signing up with the link in the description for Stockopedia. If you do join, there's a code there that gives you, I think it's 25% off. And you can see historically the revenue growth has been really nice in this business and is expected to continue to grow. At the moment, if we do look at the net profit, you can see here the dip that's currently going on in 2024. And a lot of these one-time impacts at the moment are hopefully going to go out of the system by 2025. And we'll be up to 65 million in profitability. So right now the company does look maybe a little bit expensive at 17 times earnings, but on a 4p, if they do hit the numbers they're supposed to do, and so these one-time charges do start coming out, it's actually down at 9 times earnings, which isn't too bad because, like I said, when you look at someone like a Pets at Home at the moment, that's a lot even lower than where Pets at Home has. And that's the thing is, I think, when you do look at a 4p, this is going to very quickly look a little bit cheaper than Pets at Home. Even though with Pets at Home you get a dividend, you will get this down at a little bit of a cheaper valuation, in my opinion, when the profit starts kind of kicking in. And obviously like in 8 times here. Like we said, historically, great performer. And, it used to be a gem of the stock market, but obviously a little bit of an issues at the moment. Hopefully they can go back to those profit margins where they were at previously of 6, 7, 8%. Balance sheet wise, obviously, like we said, there has been that little increase of debt at the moment as they expand into Australia. Hopefully with the profit they generate, though, they are able to pay that down because they do generate a decent amount of profitability. From an insider front as well, probably what you want to see, there has been insiders buying the shares, and in fact it's a little bit higher than where they've previously been as well. You got the chairman of the board buying at £10, as you can see here, lead director, CFO, buying at £10 around June time. And like I said, if we look at the stock right now, it's actually fallen down a little bit lower from where the inside buying has happened. Historically, bit of a mix and match where the company has traded on a P ratio. The P ratio for on an average from 2019 to 2023 has been around about 20 times earnings. Obviously, if we do see them hit the numbers and they do trade at 9 times forward earnings, it's a lot lower than historically what they do normally trade at. So very quickly, let's have a look at some numbers here. And I put 4, 6, 8% revenue growth in, so that's pretty much near bang on what they're currently targeting. Profit margin of 5, 6, 7%, which hopefully if they can ramp up the profit margin, that is where they will be at. I think if we do go back previously onto Simply Wall Street on their past performance, we did see that they did get to the profit margin of kind of 4%, 5%, 6%, up to an 8% profit margin there. So I think that is potentially achievable for them to go to 20 times earnings, because like I said, that's where the average is from 2019 to 2023. And on the low side, there's 32% upside. On the high side, mid side, 70% upside. And on the high side, we've got the 114% return, which is obviously pretty nice. The only thing that I would say that maybe the company doesn't trade at 20 times earnings, let's say the company does go down to like a 15 times earnings, and granted there is a little bit lower numbers on the high side there. So, but on the mid side and high side, there's still possibility of making numbers. Worst case scenario, I have bought a start position here. Ideally, I would like the stock to maybe drop like another 20%. If the stock does drop another 20%, I will then go double the position. If we do say that I can get my average down by another 10%, and let's say the stock does fall to about 550 million market cap, and let me just enter the numbers here of 550 million market cap, you can see the upside definitely really starts ramping up there as well. So it was just at the point where I went, actually, you know what, here I'm quite happy to kind of build the starter position up. And then if it does start going a little bit lower, obviously if it does go lower, you're talking below nearly CV coronavirus times, when you start going even lower. If it does go even lower, then I'll just start buying more. So I bought now, and if it goes up from here, hey, I'm a winner. And if the stock does continue to go down here, I think that just creates more and more upside here on this stock. And I'm just thinking that there's just so much fear around here at the moment around what is going on with the investigation, with the CMA, and I think, how much can they kind of go for these spaces? It's not like these companies are taking the mick with the amount of profit they're making. I don't know how much they can really affect them too much. So yeah, I think there's been a lot of negativities that push them down a little bit at the moment, and I thought, you know what, it's worth starting a position here, and then if it does go lower, I'll keep adding into the position a little bit here. So we'll see what happens from here. So hope you enjoyed the video, guys. I have been buying also another UK growth stock, which I will be covering probably next Friday for you guys as well. So keep an eye out for that one as well. Hope you enjoyed the video, guys, and I'll see you in a bit.